Hi everyone, welcome back to Daily Wall Street. Today is Monday, March 24th, 2025, and we're diving into a market that's cautiously optimistic, but with some serious storm clouds forming just ahead. Last Friday, U.S. stocks continued their rebound, with the Dow Jones and S&P 500 both rising 0.1%, the Nasdaq 100 up 0.4%, and the Philadelphia Semiconductor Index down 0.9%. The Russell 2000 also slid 0.8%. On a weekly basis, the Dow gained 1.2%, the S&P 500 added 0.5%, and the Nasdaq inched up 0.3%, finally breaking a 4-week losing streak. It's a relief rally, yes, but is it sustainable? The S&P is still trading below its 200-day moving average. Until we break above that resistance with conviction, it's premature to call an end to the bear trend. Now all eyes are on April 2nd. That's the day former President Trump has dubbed Liberation Day, when his administration is expected to announce the long-hyped retaliatory tariff measures. Investors are hoping for clarity. So far, no concrete details have emerged, just talk. And talk without action is what's fueling this cautious optimism. But institutions are warning. If retail traders keep aggressively buying dips, the market may be setting up for a harsher correction down the road. According to Goldman Sachs, retail traders have been net buyers on all but 7 trading days so far this year. That's a lot of enthusiasm, and potentially a lot of overexposure. Meanwhile, fund managers are doing the opposite. They've been reducing their U.S. equity exposure at a historic pace, rotating capital into Europe and emerging markets instead. Bank of America's March survey shows the largest pullback from U.S. equities in recorded history, while allocations to Europe and EMs are surging. This divergence reflects growing concern over U.S. equity valuations and the potential fallout from Trump's tariff agenda. Let's break that down. The proposed tariff plan is being reshaped, not the blanket measures once feared, but more targeted actions focused on trade abusers. These include China, the EU, Mexico, Canada, Japan, South Korea, and India. Nations with trade surpluses. With the U.S. could receive exemptions, while others may face new levies. Sectors once under threat, autos, semis, pharmaceuticals, are now off the table, at least for the April 2nd rollout. But tensions remain high. U.S. Treasury Secretary Bessent has identified a Dirty 15 list of countries that impose significant trade barriers against American goods. Taiwan, for instance, was flagged for its steep 17.5% import tariff on U.S. cars. Even if immediate economic fallout isn't visible yet, this uncertainty is already weighing on market sentiment. Tariffs serve a dual purpose, rerouting global investment back into the U.S. and creating new revenue streams to offset fiscal pressures. Analysts warned that the tariff measures could boost U.S. inflation by up to 1.9% and shave as much as 0.7% off GDP. The EU and China could be hit harder, with projected GDP contractions of up to 1.5% and 1.9% respectively. So where do investors go for safety? That's where bonds come in. The recent drop in yields has revived interest in treasuries. The 2-year fell to 3.96%. and the 10-year slipped to 4.25%. That's helped push long-duration ETFs like TLT into positive territory. With both stocks and bonds rising last week, are we finally entering a new regime where fixed income plays a stabilizing role? The U.S. deficit is still high, and the Treasury is trying to gradually cut spending instead of applying harsh austerity. The idea is to manage debt without triggering a recession. This fiscal juggling act makes bonds more attractive as a hedge. They provide steady income and may outperform equities in the event of renewed market stress. Plus, global investors are increasingly turning to diversified portfolios, allocating into gold, corporate bonds, and short-term treasuries. Multi-asset strategies, long considered underperformers compared to pure U.S. equities, are finally seeing a turnaround. Year-to-date, balanced portfolios are up 3 to 5%, signaling a structural shift in allocation preferences. Now let's turn to another important headline, the Fed's back-to-back years of operating losses. In 2024, the Fed lost $7.76 billion due to an imbalance between its low-yielding assets and high-yielding liabilities. It pays 4.4% interest on bank reserves, while earning just 2.6% on bonds bought during the pandemic. It's like earning minimum wage but paying luxury rent, an unsustainable gap. Still, the Fed uses a special accounting method to defer these losses, allowing normal operations to continue. No, it won't go bankrupt, but it also won't be remitting profits to the Treasury anytime soon, which marginally adds to the federal deficit. So what's the way forward? As rates begin to decline, the Fed is expected to return to profitability in a few years. But until then, this operating loss becomes another layer of complexity in a market already juggling tariffs, debt, and geopolitical risk. Meanwhile, tech stocks helped drive last week's market gains. Microsoft, Apple, Amazon, Google, and Meta all rose, with Tesla standing out with a 3.5% surge. The rally followed public endorsements from Trump's inner circle. Commerce Secretary Lutnick urged investors to buy Tesla, calling the stock unbelievably cheap. That's unusual. Government officials rarely endorse individual companies. Plus, Lutnick's fund holds $300 million in Tesla stock, raising eyebrows over potential conflicts of interest. Retail investors, though, didn't hesitate. According to JP Morgan, they poured $8 billion into Tesla over 13 straight days, the biggest buying spree since 2015. Tesla's stock is down 50% over the past 3 months. This kind of retail confidence can fuel powerful rebounds, but also amplifies volatility if momentum fades. Elon Musk, meanwhile, held a company-wide rally to re-energize the base, citing breakthroughs in self-driving AI, energy storage, and even humanoid robotics. He believes Tesla is on track to become the world's most valuable company, with its robot product line potentially reshaping productivity and labor markets worldwide. Will that be enough? That depends on whether the next earnings report or delivery numbers can match the hype. For now, caution is warranted. Tesla may have bottomed short-term, but upside catalysts must materialize to break above resistance and avoid another leg down. Into A's. Conclusion. Today's market reflects hope, with a big but. Yes, there's a rebound. Yes, bonds look strong. But with tariffs looming and the Fed under pressure, now is the time to reassess your allocation strategy. Diversify, de-risk, and stay nimble. Thanks for watching. Don't forget to like, subscribe, and drop your thoughts in the comments below. We'll see you tomorrow on Daily Wall Street.